Welcome. In this video, we're going to take a look at one of the best known secrets of retirement planning in Canada, and that is the tax treatment of Canadian eligible dividends. Specifically, we're going to be taking a look at how the dividend tax credit can lead to negative tax rates in retirement. Knowing how this works can be a powerful tool when it comes to retirement planning in Canada. I'm going to give you a quick example, and then we're going to take a closer look at how this works. Now imagine you're getting $10,000 of Canadian eligible dividends, and imagine you have a choice of which type of account you want to receive that income in. It could be an RSP, it could be a TFSA, or it could be a non-registered account. Which one do you choose? Imagine you're in Ontario, you're in early retirement, your income per person's around that $52,000 level or below. Where do you pay out that $10,000? Is it an RSP? Well, probably not, because that gets taxed at your marginal tax rate. You're going to pay about $2,000 in tax on that $10,000 of Canadian eligible dividends. You might be thinking a TFSA, there's going to be no tax. It's a tax-free savings account. There's going to be no tax on that $10,000 of Canadian eligible dividends. That must be the right choice, right? Well, it's not. At this income level in Ontario, the non-registered account would lead to a negative tax of $755, a negative tax. You could actually use that negative tax to offset other tax on income that you earned at that tax bracket. This is why it's so important to understand how the dividend tax credit works and how it can lead to negative tax rates in retirement. Now in this video, we're going to take a look at a number of different things. We already took a look at the RSP versus TFSA versus non-registered example. We're going to take a look at how dividends are taxed, how that calculation actually works, specifically the dividend tax credit and how that leads to negative tax rates in certain provinces. We're going to look at the provinces with negative tax rates, and there's a new province added to that list this year, so we're going to take a look at that one as well. We're also going to take a look at the changes happening in 2026. This will be changing for the better in 2026, so you don't want to miss that. And we're also going to take a look at how this impacts your retirement plan. So knowing all this information, how do you use this to your advantage in your retirement plan? Now, we already took a look at the example of the RSP, the TFSA, and the non-registered account, but now let's get more specifically in how dividends are taxed, specifically the dividend tax credit and the negative tax rates that can result. Now, how dividends are taxed. So let's look at an example with a $10,000 Canadian eligible dividend. The first thing that happens is that it gets grossed up by a specific percentage. At the moment, that's 38%. The grossed up amount is trying to reflect the pre-tax amount that the corporation earned. So it's taking the $10,000 Canadian eligible dividend and it's grossing it up by 38%. So we end up with $13,800 as the grossed up amount. This is actually the amount that will hit your tax return, your taxable income line. This is important because it does sometimes trigger OAS clawbacks or GIS clawbacks that you maybe weren't intending. So that gross up amount is super important to understand. Now it gets applied, the tax rate gets applied to that grossed up amount. The combined federal and Ontario tax rate at the moment at a lower income level in Ontario is 19.55%. That gives us tax of $2,698 or so. So we take the grossed up amount times the marginal tax rate. Now the dividend tax credit gets applied after that. So we have our grossed up amount, we have our tax that we're going to pay, but then we have to apply our dividend tax credit. Now the dividend tax credit is trying to reflect the fact that the corporation has already paid out tax, corporate tax, before it paid out that dividend. So it's trying to give you a credit for what that tax was, and it's trying to replicate that amount. The amount, the tax credit rate at the moment, federal and Ontario, is 25.0198%, a very specific amount. So we take the grossed up amount, the $13,800, times the dividend tax credit rate. That gives us our dividend tax credit of $3,453. And you'll probably also already notice that this leads to a negative amount. We have tax before credits of about $2,698. We have a dividend tax credit of $3,453. That leads to a negative tax of $755. So on a $10,000 Canadian eligible dividend, we end up with a negative tax rate of 7.55%. Now that we know how the dividend tax credit works and how it leads to negative tax rates, let's look at some of the provinces that have negative tax rates and the new province that just got added this year. Now let's take a look at the different provinces that enjoy a negative tax rate on Canadian eligible dividends, specifically in retirement when we're in lower tax brackets. So we're just on taxtips.ca here. You can already see the negative 7.55% that we had highlighted in our calculations in Ontario. That's at the first income level in Ontario. Even at the second income level, you still have a negative tax rate here in Ontario. So not until you get up to that third income level does the tax rate actually end up going positive. So in Ontario, lots of tax planning opportunities, especially in retirement when you're in a lower tax bracket. Now let's flip over to BC, which actually has a even better tax rate. So at the lower income level in BC, we have negative 10.29% on Canadian eligible dividends. Super attractive if you're in BC. At the second income level, we also benefit from negative tax rates. Now the new province to join this list is Alberta. Alberta, with the changes in the provincial and the federal tax rate, means that in Alberta, in the first income level, we now also have negative tax rates on Canadian eligible dividends. So if you're in Alberta, if you're approaching retirement or in retirement, keep this in mind. This is an interesting tax planning opportunity that maybe you didn't have before. So keep this in mind as you're doing your retirement planning in Alberta. So now that you know which provinces have negative tax rates on Canadian eligible dividends, let's take a look at how this changes in 2026. Let's look at the same example we had before, $10,000 of Canadian eligible dividends, but let's see what happens in 2026. For those of you who don't know, the federal tax rate is going down to 14% in 2026. It was at 15% in 2024, it got phased in 2025, and in 2026, it's going to be 1% lower than where it was in 2024. Now this results in an even lower negative tax rate on Canadian eligible dividends in that first tax bracket. So we have our grossed up amount, but now we have a lower combined federal and Ontario tax rate that leads to a lower tax before credits. We have the same credit being applied, and so we actually end up with a lower tax rate of negative 8.24%. So instead of negative 7.55%, it's now going to be negative 8.24%. The same thing is going to apply to BC and Alberta as well. So those negative tax rates that we just saw on taxtips.ca, they will be getting even better as of 2026. So now that we know the changes happening in 2026, let's see how this affects your retirement plan. So let's take a look at the same example, 10,000 of Canadian eligible dividends being paid in a non-registered account in 2026 and beyond in Ontario at that lower tax bracket. It's going to lead to a negative tax of $824. Now, the dividend tax credit is non-refundable, so we need to trigger some sort of income to take advantage of that negative tax rate. So we need to find some sort of income that generates another $824 of tax at a minimum. We want to maybe make a withdrawal from an RSP to trigger that income tax. And so the pre-tax amount that we need to withdraw to trigger that much tax at that tax level is about $4,325. So the combined income that we're going to be getting in this case is a bit over $14,000, but we're going to pay zero income tax on that entire amount. This is the powerful nature of this sort of insight, this sort of tax planning, is that in BC, Alberta, Ontario, you can trigger additional income to use up those non-refundable tax credits. Now, rather than doing all these calculations by hand, which would be kind of crazy, you want to use a retirement planning platform like Advice to figure all this out for you. Advice is just $9 a month or $49 for the year, and it does all of the heavy lifting in terms of the calculations. In this example, which is one that we had from 2 weeks ago, we had $1 million of financial assets. They were spending $80,000 a year. They had income from CPP, old age security, registered withdrawals, non-registered in TFSA, a total of $80,000, and they were paying zero tax every single year. If you can do this planning in advance, if you can take advantage of these tax credits, it can lead to some very favorable retirement planning opportunities. Let me show you where those tax credits show up here within the platform. If we go to Linda's total tax, and we open up the federal tax, and it will be the same on the provincial side, we can see the eligible dividend tax credit offsetting $1,300 of tax. Now, her partner David has the same tax credit, and they both get the provincial credits as well. We're offsetting thousands of dollars of tax by using the dividend tax credit on Canadian eligible dividends. If you can do this sort of planning in advance, if you can build a retirement plan that takes advantage of these opportunities, it can lead to some very favorable retirement plans, some very favorable tax planning in retirement. Now, I love retirement planning, and I would love for everybody in Canada to have a detailed retirement plan. That's why we made advice so expensive. It's just $9 a month or $49 for the year. It's so incredibly inexpensive because we want everybody in Canada to have access to a detailed retirement plan. For the reasons we just saw, having a retirement plan in place, understanding the opportunities and taking advantage of them can lead to some very favorable outcomes. If you're approaching retirement, if you're in retirement, you need to have a detailed retirement plan. And at this price point, there is no reason why you shouldn't have one in place. Thank you so much for watching, and we'll see you with the next one.